All right, crude oil prices are flat after initially spiking following an attack on Israel by an Iran-backed proxy group, inflaming fears of a wider conflict in the Middle East. To discuss, Bob Iaccino, Path Trading Partners co-founder and chief market strategist, is here. Bob, what's your latest take on the move in the oil markets, and what's the next trade?
Well, I think initially from the fundamental perspective, the move is correct because we have seen reduced demand, especially out of China. And that's one of the bigger concerns for the market in a commodity like crude oil. Copper would be another representative of that. The recent moves that we've seen in that particular industrial metal has a lot to do with China's weakness. When the People's Bank of China actually cut rates in a surprise to the market last week, it drove a lot of those sort of longer term holds out of both assets, both crude and copper. Now, on the other hand, we do have a meeting coming up. It's not a formal meeting, but August 1st, OPEC and OPEC Plus will meet to sort of reassess the production cuts and whether they've done what they were supposed to do. And when you look at the last comments, or I should say the comments right after the last meeting in June from OPEC, from the Saudi oil minister, he basically said that the market doesn't understand what we were saying here and prices will soon rise. I'm paraphrasing. But he essentially said that while the markets interpreted that as sort of an open window to an increase in production sometime in the future, they didn't see it that way at all. So unlike normal times, you usually get a leak from OPEC from somebody at some point as to what the direction or decision is going to be. We haven't seen that yet, but they could actually deliver an August surprise in terms of more production cuts. It's possible.
Bob, great to see you here this morning. You know, I mentioned this stat from FactSet earlier in the show, and I'll mention it here to you and get your thoughts on it. As FactSet had said, despite this 9.7% year-over-year increase in the average price of oil during the second quarter of 2024 relative to second quarter of 2023, energy sector seeing the third largest earnings decline of all 11 sectors in the S&P 500 right now. What does that set up for some of the energy companies that are expected to report later on this week? And what do they need to tell to the street, to the analysts that are going to be listening in?
Well, one of the things that we need to look at, especially in the domestic oil patch, is that should do really well from an earnings perspective, because while prices are lower, their break evens through technology have continued to move ever so slightly lower. And the oil they're getting out of the ground has been cheaper, yes, but the demand here in the U.S. has not been weak. So when you're looking more at domestic energy companies, you might see a surprise. The more integrated global companies, that could suffer because, again, of their operations overseas. But I would remind people, if you believe that the economy is not slowing as much as some people think at this point, then you're a believer in the reflation narrative, which I still am a believer in. And one of the best performing sectors over the long term during reflation narratives, which is, of course, a growing economy and a little bit stronger inflation than the Fed would like to see, that would be energy. It's one of the best performing sectors. So it could actually be an opportunity from a stock perspective, especially if we get sort of fair to midland, for lack of a better phrase, earnings, Brad, then you could actually have a buying opportunity in energy.
Bob, if Vice President Harris continues to close that gap in the presidential race against former President Trump, how bearish would that be for oil stocks?
It would be pretty bearish. I mean, she came out when she was running for president in 2016, or was it 2020? I get so confused with these election cycles now. I believe it was 2020. But she actually flat out stated, I'm against fracking. And one of the things we're seeing in the U.S. From a structural standpoint is rig reductions. Oil working rigs are starting to reduce at a pace that's alarming because CapEx in the U.S. has not been as strong as you would like to see. Now, those rigs are producing more crude than they did in the past, again, due to technological advancements. But if we don't get assistance, and I don't mean necessarily financial assistance, but assistance from the regulatory structure, then the production will start to fall off in the U.S. And if the U.S. production falls off, then you're going to see prices rally in crude.
Where more broadly, especially as you look across some of the decisions that are going to need to be made on a geopolitical front over the next few months and even into next year on production, where could that have a more outsized impact on where we just see the prices for WTI and Brent moving?
Well, you don't want to. You guys mentioned the attack on Israel over the weekend. You don't want to see that continue to flare up. You really don't. Israel is one of the only successful countries in that region that doesn't have oil. So if they started fighting back against some of the proxies, some of the countries that support these groups, and it's over my pay grade to say which countries those are. But if Israel decides there's a country that matters from that standpoint, you're going to see a spike in Brent. When you see a spike in Brent, you see a spike in WTI. The interesting thing about crude oil is it is very much a structural supply and demand market. How much oil's out there and how much oil are people using? And that's it. That's the way we derive price. And that's why you see these wide bands, but sideways bands in crude oil charts over long periods of time, because there needs to be a disruption in one or the other. Now, demand disruptions or accelerations happen gradually. Supply disruptions happen all at once, and they're usually from a geopolitical flare-up. So that would be what I would be most concerned about.
Bob Iaccino, who is the Path Trading Partners co-founder and chief market strategist. Bob, thanks so much for taking the time here this morning.
Good to see you guys. Good to see you, Brett.